Hey everyone, welcome back to Corporate Decoder, the place where we unpack the complex world of business. And let me tell you, this report has some serious layers from Pelican Acquisition Corporation, also known as Pubco, and its target companies Greenland Exploration Limited and March GL Company. Get ready because we're diving into a deal that is going to make some big changes, especially for offshore oil and gas. Before we jump into the wild ride that is this filing, if you love getting the real scoop from these kind of documents, make sure you are subscribed. We also have a Discord community linked in the description below where you can discuss these findings with other viewers. So what is the big story here? Essentially, Pelican Acquisition Corporation, a special type of company called a SPAC, is trying to merge with two energy companies, Greenland Exploration Limited and March GL Company. The goal is to take these companies public and create a new entity called Greenland Energy Company, which is pretty fitting. Think of it like this: Pelican is like a special purpose vehicle that raises money and then finds a company to merge with, basically taking them public. In this case, they found Greenland and March GL, which are in the oil and gas exploration business, specifically focusing on the Jameson Land Basin in Greenland. This area is described as a frontier exploration zone with a ton of potential, but historically undrilled. Now, let's get to the juicy part, the financials. We've got a pro forma balance sheet here, which is basically a snapshot of what the combined company might look like after the deal closes, prepared under a few different scenarios. First up, the no redemption scenario. This assumes no shareholders of Pelican decided to cash out their shares. In this case, total debt is sitting at $9.6 million. Stockholders' equity, a measure of the company's net worth, is around $75.7 million. This looks pretty solid on paper, suggesting a healthy balance sheet if no one redeems. But then we look at the maximum redemption scenario. This is where things get dicey here. They're assuming everyone cashes out their shares. Total liabilities jump up significantly to about $9.6 million, which isn't too bad, but the stockholders' equity takes a massive hit, ending up as a deficit of nearly $86.2 million. This means if everyone redeems their shares, the company would be underwater before it even truly starts. Keep this in mind as we look at the other numbers. Looking at the combined statement of operations for the 9 months ending the 30th of September 2025, the company's reported a loss from operations of $3.1 million. That is before even considering other income, which, in Pelican's case, was mostly interest earned on their trust account funds. The pro forma net loss under both the no redemption and maximum redemption scenarios remains the same, around $3.1 million, highlighting that the core business operations are generating losses. Now, let's talk dilution. In the no redemption scenario, the net loss per S-share for non-redeemable shares is about $0.09. But if we look at the maximum redemption scenario, that loss per S-share widens to around $0.12. This means existing shareholders who don't redeem could see their ownership stakes value diluted if too many shares are redeemed and the company has less capital to work with. This table gives us a clearer picture of how shareholder equity changes. We see the initial capital from the sponsor and underwriter totaling around $29,000 at the start, but then these redemptions and transaction costs, which are quite substantial, eat into that equity. It is a stark reminder of how redemptions can significantly impact the balance sheet. Now, let's talk risks, and there are quite a few. The company is upfront about the possibility of shareholders redeeming their shares, which could leave the combined entity with less capital than planned. They also mention that since this isn't a traditional underwritten IPO, there might not be the usual independent review from investment banks, potentially meaning some risks might go undiscovered. This is a big one. If too many SPAC shareholders decide to cash out, the deal might not go through, or the company might end up with less money than it needs to operate. They specifically say they can't guarantee they'll have enough capital to execute their business plans in a high redemption scenario. And then there is the geographic risk. Operating in Greenland presents its own set of challenges. It is a frontier exploration area with limited infrastructure, and they're subject to specific local regulations for oil and gas activity. Any changes there could really impact their costs and timelines. Let's dive into the actual deal structure, the agreement and plan of merger. This is the legal document outlining how everything goes down. It is quite complex, involving a domestication of Pelican from the Cayman Islands to Texas, followed by a series of mergers. This is a common structure for SPACs, aiming to create a more favorable legal and tax environment. The consideration for the deal is primarily in the form of shares. Greenland Exploration Limited shareholders are set to receive about 1.5 million shares of Pubco common stock, and March GL Company shareholders will get a whopping 20 million shares. This is based on a valuation of $10 per S-share, totaling $215 million. It shows that the existing shareholders of Greenland and March GL will hold the lion's share of the post-merger company, which is typical when a SPAC merges with an operating business. Several conditions need to be met before this deal actually closes. Shareholder approval from Pelican is key, and they also need NASDAQ listing approval. Significantly, Pubco needs to have at least $5 million in net tangible assets after redemptions and any PIPE investment. This is a crucial number to watch, as it directly ties into the redemption issue we saw in the financials. If redemptions are high, meeting this threshold could be challenging. Now, the board got a fairness opinion from Entrepreneur Shares LLC. This is basically an independent assessment saying the deal terms are fair financially. They looked at comparable public companies and transactions, and their analysis suggested the deal value was within a reasonable range. They also did a commodity-based valuation, particularly for two well prospects, estimating potential oil in the billions of barrels. While intriguing, it is important to remember these are prospective resources, not proven reserves, and the valuation is highly dependent on future commodity prices and successful drilling. So, what is the takeaway here? Pelican Acquisition Corporation is merging with two energy companies, Greenland Exploration Limited and March GL Company, to form Greenland Energy Company. The deal aims to unlock the potential of the Jameson Land Basin in Greenland, which is described as having massive oil reserves. Financials show a significant dependence on the success of the merger and the capital injection, with a concerning deficit in the worst case redemption scenario. The company is operating in a frontier environment with inherent regulatory, environmental, and operational risks. The leadership team seems experienced, particularly in finance and navigating complex corporate structures, but the success hinges on raising substantial capital and de-risking exploration activities with no guarantee of discovery. It is a high-risk, potentially high-reward venture, typical of frontier resource plays, and investors will be watching those redemption numbers and drilling results very closely. Alright, that is our deep dive into this SPAC merger. What do you think about this deal and the potential for Greenland's oil reserves? Let us know your thoughts down in the comments. If you found this breakdown helpful, give this video a thumbs up and subscribe for more. And don't forget to join our Discord community linked in the description below for more discussions. Thanks for watching, and we'll see you in the next one. Hey everyone, welcome back to Corporate Decoder, the place where we unpack the wildest financial documents out there. And today we've got a big one involving a SPAC, some Greenlandic oil dreams, and a whole lot of legal maneuvering. Get ready, because this report is packed with more twists and turns than a Norwegian fjord. So, what is the main event Pelican Acquisition Corporation? A SPAC is merging with two energy companies, Greenland Exploration Limited and March GL Company, to create a new entity called Greenland Energy Company. The big prize is the Jameson Land Basin in Greenland, an area touted for its massive oil potential, but it is also a frontier territory with all the risks that come with it. Let's jump right into the numbers from the filings, because that is where the real story often lies. First off, we're looking at the pro forma balance sheet. This shows what the company might look like financially after the merger, and it is presented in three different scenarios based on how many Pelican shareholders choose to redeem their shares. Scenario 1, the no redemption scenario, assumes nobody cashes out. Here, total liabilities are around $2.3 million, but stockholders' equity is a healthy $75.7 million. This looks pretty good. Then we have the 50% redemption scenario. If half the shareholders redeem, total liabilities bump up to about $2.3 million, but that stockholders' equity drops almost in half to around $35.9 million. This is already a significant decrease in the company's net worth. And finally, the maximum redemption scenario. If everyone redeems, total liabilities stay around $9.6 million, but that stockholders' equity plummets to a negative $6 million. Yes, you heard that right, a deficit. This means if a lot of shareholders redeem, the company could be financially underwater right out of the gate. This is a critical detail that Warren Buffett would definitely be scrutinizing. Moving to the statement of operations for the 9 months ended the 30th of September 2025, the combined pro forma loss from operations is about $3.1 million. This shows that even with the merger, the core business is still losing money. And when we look at the net loss per S-share for those who hold onto their shares, it is about $0.09 in the no redemption scenario, but it jumps to $0.12 in the maximum redemption scenario. This simply means that if a lot of people redeem, the remaining shareholders' piece of the pie shrinks, and their potential losses increase if the company underperforms. Digging a bit deeper, we see Pelican's historical financials also show a very lean operation, mostly just general and administrative expenses and some minor interest income before the IPO. This is typical for SPACs. Their real action happens after they merge. Now, the risks, they're quite upfront about it. The company explicitly states that if too many shareholders redeem their shares, they might not be able to complete the business combination, or the resulting company might not have enough capital to achieve its business plans. This is a critical risk factor that could derail the entire deal. Operating in Greenland adds another layer of complexity. It is a frontier area, meaning less established infrastructure and potentially stricter environmental and political regulations. Any misstep there could be costly and time-consuming. The core of this deal is the agreement and plan of merger. It details a domestication where Pelican changes its legal home from the Cayman Islands to Texas, followed by a series of corporate mergers. This is a standard move for SPACs to simplify their legal structure for a US listing. The deal itself is largely settled with stock. Greenland Exploration Limited shareholders get about 1.5 million shares, and March Gill Company shareholders are set to receive 20 million shares of Pubco common stock. This is valued at $215 million, with each share notionally priced at $10. This structure means original shareholders of Greenland and March Gill will own a significant chunk of the new company, which is common in these types of SPAC combinations. For this deal to actually happen, several conditions need to be met. Shareholder approval from Pelican is a big one, as is getting NASDAQ listing approval. A key condition is that after everything, including redemptions and any potential PIPE investment, Pubco must have at least $5 million in net tangible assets. Given the potential for high redemptions seen in the financials, reaching this threshold could be a major hurdle. The company also obtained a fairness opinion from Entrepreneurshares LLC. They concluded the deal is financially fair. Their analysis, which looked at comparable companies and transactions, placed the company's potential value in a broad range. They even used a commodity-based valuation, estimating billions of barrels of prospective oil resources in Greenland. However, it is crucial to remember these are prospective resources, not proven reserves, and the actual outcome is very uncertain. So, what is the story here? Pelican Acquisition Corporation is effectively buying into Greenland Exploration Limited and March Gill Company, aiming to bring them public as Greenland Energy Company. The main attraction is the massive potential in the Jameson Land Basin in Greenland. But this comes with significant risks like regulatory hurdles and high capital needs. The financials paint a picture of a company heavily reliant on the merger completing successfully, especially if many shareholders redeem their shares. The leadership team has experience in mergers and finance, but the success of this venture will hinge on a successful exploration program and securing future funding. It is a bold play in a challenging environment, and investors will be watching closely to see if this frontier exploration bet pays off. Alright, that is our decoder for this complex corporate maneuver. What do you think about this deal and its prospects? Let us know your take in the comments. If you found this analysis valuable, please hit that like button and subscribe for more insights, and remember, join our Discord community linked in the description for more discussions. Thanks for watching, and we'll see you next time.